Small business credit secrets. Here are the 6 C's all banks are looking for. Banks review the 6 C's to figure out the financial status of the company that's seeking funding. How does your business stack up? Welcome back, folks, to another edition of 𝗬𝗘𝗧𝗛𝗧. I'm doing fantastic today. I hope you are doing marvelous. If you're doing as marvelous as I am, go grab a cup of coffee or tea or vodka and let's roll. Today I'm going to give you 6 elements, 6 key factors that banks look for when it comes to small business credit. Number 1, communication. Communication is very important. Your willingness to communicate openly with your banker and other advisors about the opportunities and challenges your company faces is very important. Now, people all kind of think about bankers and lenders as some kind of a weird category. No, if you want to cultivate a great relationship with your loan manager, right? You want to treat your lender as a partner, right? The lender is a part of your team. The lender is an indispensable partner who helps grow your operation. And if you have that in mind, you're able to attract to you a person, a loan manager or an account manager who will treat you honestly and in a mutually respectful way. You communicate with your lender, all right? I'm not saying call them every day, no, but if there is something going on, tell them. Be quick to communicate openly about your situation. The lender wants to hear the problem. If you have company problems, if your business is running through some issues, your lender wants to hear that from you, right? It's not about hearing this in the news or hearing it from rivals or hearing from other channels. You want to be the one calling your lender and say, hey, listen, I told you this a year ago, but right now we're having some issues in the industry, but I just want to let you know this is more FYI. Don't worry, they wouldn't start a process of getting their money back, no, and they wouldn't force you into bankruptcy. A lot of small business owners are kind of scared to talk about financial difficulties with their banker. No, this could be an opportunity to even extend you more money so that you can write up, you can actually navigate a difficult moment. Explore all the options your bank can provide. Now, if you're able to communicate with your lender on a regular basis, chances are you will be in the first to know what kind of new products and services the bank offers, right? So you basically have access by speaking to the right person regularly. Again, it's very important. Regularly, you have access to a catalog of services and products that the bank has, and that could really help you in terms of structuring your deal, structuring your loan deal in a manner that that benefits you, right? I mean, for instance, you want to to do this, you want to make sure you want to read more about the bank structure, limits in lending, products, covenant, interest rates, expertise level, and commitment to the industry you're in. It's very important. You want to figure out what kind of relationship you can have with that bank, with your loan manager. Another way to communicate properly is to treat every conversation you have as a professional exchange. Check your emotions at the door when you talk to your loan manager. Act in a very honest way, but please, no need to feel angry, upset, or frustrated. It doesn't really help. All right? Because you have to understand that while you are kind of scared about your company, filing for bankruptcy or your company not making enough money, the lender is also trying to survive in the same environment. They have to manage their cash flows. They have to manage their balance sheet too. So everybody's is in the same boat, right? So that's very important. Number 2. So the first C was, as I said, the first C was communication. Second C, conditions. Now, conditions stands for, I'm talking more exogenous condition, things that you can't control. For instance, the state of the economy. Before extending credit to you, the bank will do some analysis about the overall health of the economy. They will look at trends in your particular industry. Are you an industry that is growing, high growth industry or decline? They want to pay attention to that because, if even if you have a great business plan, you're able to say, I'm the best, I have the best products or service, but you are navigating in a downtrending industry, chances are later on, sooner or later, the downtrends will catch up to you, will catch up to your business. So the bank wants to know. The bank wants to also know if there are some disruptive factors in the industry. In other words, is there any kind of technology threat? You work in an industry that relied for many years on manual input and manual labor. Is there any disruption on the horizon coming from, technology? Banks want to take a look at that. The bank also wants to pay attention to pending legislation relative to your business, right? Is Congress considering some kind of law, or is your state capital considering some kind of law? So the bank wants to know what the legislators have in mind, and if the pending legislation will be adverse, will be detrimental to the kind of sector you're in or to your particular company. And the last thing the bank wants to look at is the social reputation of your sector, right? How the public perceives your sector. So this is very important to kind of think about. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of Sweetie Kiwi. We're still continuing our conversation around the 6 C's all banks are looking for when it comes to small business credit. If you like the content's clarity and quality so far, please consider subscribing to our channel and turn on the notification bell. Also, if you would please like the content, share, comment below, we really appreciate it. The third C stands for collateral. Now, what is collateral? It's just an asset or property that your business offers to a lender as security for a loan, right? So basically, you can use it as a way to obtain a loan. It can act as a protection against potential loss for the lender should your company default in its payments, right? So if you cannot repay the loan, the collateral becomes the property of the lender to compensate for the unreturned borrowed money. Think about it as a mortgage, right? If people have to, in a foreclosure process, the bank will sell the house and try to recoup whatever is recoupable. All right. So the accounts receivable, inventory, cash, equipment, and commercial real estate, they are all form of collateral that banks leverage to secure loans. Now you have to understand that the bank will look at the value of your collateral, but it will also consider any existing debt you may still owe on that collateral. What I'm trying to say is, if you go to let's say you have equipment that you want to mortgage, right? You want to collateralize, you want to use this collateral, but you owe, the equipment is worth $500,000, but you owe $200,000 on that equipment. So the bank is only thinking, hey, your interest in that equipment, in that piece of equipment, is only $300,000. So if they have to lend you money, if they have to give you some cash, they have to make sure they don't go over $300,000. Now, when it comes to collateral, you have several types of collateral. I gave you a few of them a while ago. So real estate, this is the most common type of collateral used by borrowers. It could be land, it can be a parcel of land, it could be your home. You also have inventory financing, right? So basically the bank will give you the money, but you use the money to buy inventory, but the bank owns that inventory. There's also something called invoice collateral. So basically you would send, the money will go to the bank. So basically you assign your accounts receivable to the lender, right? Because earlier I was just talking about the fact that there might be some seasonal trends, there might be some issues in terms of payments, cyclically in your business. So you wouldn't have the money very early. Let's say, your customers will pay you in 90 days, where you have to pay your suppliers in 45 or 60, right? So you can get invoice collateral. You can use invoice as collateral, where the bank advances the money to you today, but when the customer is paying you back in 90 days, the money goes straight to the bank. All right. You also have something called blanket lien. Now, blanket lien is a legal claim allowing a lender to dispose of the asset of a business that is in default on a loan. So there are a lot of stuff. There are a lot of schemes that can be used to collateralize a loan. The fourth C the banks look for is capacity. Now, by capacity, I'm talking about financial capacity. All right. So this is, in essence, your company's financial capacity is really the financial limit of your business. It's the financial limit of your business ability to absorb losses with its own funds or borrowed funds without any major disruption. I'll give you an example. Basically, let's say you have, and this goes back to what I said earlier about having some kind of emergency rainy day fund. Let's say a risk manager attempts to find the appropriate retention amount. So you want to figure out whether or not your business has the financial capacity to support debt and expenses, right? So let's say you have $1 million in cash and cash equivalents, and you have debt of $800,000, and you have monthly recurring expenses of $300,000. Obviously, that's more than 1 million. So that's 1.1 million. So your business may not be in a position to support every dollar of that service. So this is very important. So you want to be able to get that, and you can boost your financial capacity through various ways. You can plan your business through business planning. You can boost your financial capacity or business operations. Now, business planning involves things like scenario planning, financial plan development, financial forecasting, financial analysis, budget development. So you actually sit with your personnel trying to find out what's really happening. Cash flow management, right? So you prepare cash flow projections for 6 to 12 months, for instance, right? And due diligence. So you're trying to get some intel on the industry you're in, or you're getting intel on your supplier, on your key suppliers, or on your key customers. Now, that was for business planning. You can also boost your financial capacity through business operation, right? So business operation here, I'm talking about how you run the business on a day-to-day basis. And you can look at things like, internal controls. You can look at your IT system to see what really works, what doesn't work. You can also take a look at the process and procedures, in your company, things like HR policies, or things like cash flow management policies. You also want to pay attention to training and development. Remember that your staff, your personnel are your number one capital. We're talking here about creditworthiness and cash and assets, but your number one assets are your employees. Without employees, your business is not going anywhere, right? I mean, we're not in the world of AI already, or robots, or robots have taken over the jobs of humans. But right, so when you plan your business, if you want to boost your financial capacity, you have to invest in training and coaching and development of your staff. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of Sweetie Q. We're still having a conversation here about the 6 C's all banks are looking for when it comes to extending credit to a small business. Now, I've given you 4 C's so far. Let's talk about the next 2, the last 2. C, the 5th C is capital, right? So let's say, your business owns capital assets, right? Such as equipment, cash. Now, is there enough to help support the financing you want? Right. Let's say that you have to figure out whether you have the right level of capital asset at this moment. Now, what is capital asset? Now, a capital asset is owned for its role in contributing to the business ability to generate profits. In other words, any assets, anything that allows you to generate income in the future is considered a capital asset. I'm talking about, for instance, property, plant, and equipment, right? So you have land, building, machinery, like those assets. They can be liquidated in worst case scenarios, such as if your company is restructuring or declares bankruptcy, right? Now, in other cases, your business may dispose of capital assets if the business is growing and needs something better. Okay, I mean, I'll give you an example. Let's say you're growing and you started with 20 employees and you were making $1 million a year, and you're growing so fast that now you have to hire and have a staff of 100 people, and because you're making now 10 or 15 or 20 million. In this case, you may sell one property owned by the business right now and buy a larger one in a better location, right? So this is very important. You have to pay attention to your capital, and the bank, before extending the money to you, will also pay attention to that. Now, remember that capital assets can also be damaged or become obsolete, right? So that means that if if an accountant talk about asset impairments, they say an asset is impaired. In other words, its fair value, fair value decreases. So the what's very important to understand here is that the bank, before giving you the loan, will want to appraise the value of the capital asset that you are putting forward, maybe as collateral or something else. Number 6, and this is the last C here, character. Character is very important because, and this harks back to what I said earlier about establishing a relationship with your loan manager, with your lender. Actually, that was the first C. The first C was communication, and communication has a lot to do with character, and vice versa. So you want, before giving you the money, the banks looks at a whole host of things, including you, the leader of the company, your work experience, your experience in the industry, and your personal credit history. Those are all character traits banks will consider, right? They also take a look at your personal integrity and good standing, right? And most importantly, the integrity and standing of those closely associated to the success of the business. Let's say you have 2 or 3 co-founders or 4 co-founders. They want to pay attention to, the bank will pay attention to the character traits of those people too, right? This is very important. I guess what I'm trying to say here is that the bank understands that they are in the business of trust, and banks want to make sure that they are surrounding themselves and they're lending to entrepreneurs who are trustworthy. So before someone becomes creditworthy, they first have to be trustworthy, right? Creditworthiness follows trustworthiness. So work on your character, work on your reputation in the industry, your reputation online, make things professional, set up proper accounts for the company. Or for instance, on LinkedIn, which is a professional network, you can actually also set up a whole account for yourself. So my point here is that give a great impression the first time and all the time. All right, folks, that's it for today. Thanks a lot for listening to me. Just want to quickly recap the 6 C's all banks are looking for include communication, conditions, collateral, capacity, capital, and character. Until next time, remember, stay marvelous.